Good afternoon, City of San Diego employees. Thank you for joining us today for Cal Coast Credit Union's Financial Wellness Webinar. We're honored to have you with us today. The City of San Diego is our most important partnership, and we're honored to provide financial wellness resources. My name is Will Rivera, and I'm the Manager of Financial Education at Cal Coast Credit Union. I'm thrilled to spend this hour with you as we discuss strategies for financial success. Cal Coast Credit Union is proud to be San Diego's longest serving financial institution. We were founded in 1929 by educators. Since day one, our mission has been to build a community-driven culture and empower our members with tools and resources they need to thrive financially. And today, I'm excited to welcome you to our webinar titled Savvy Savings, Mastering the Art of Financial Security. Now, having a solid understanding of saving strategies is vital because it equips you to manage financial challenges effectively. Before we dive in, I'd like to mention that all attendees will be placed on mute. However, during the presentation, if you do have a question, please utilize the Q&A function at the bottom of the screen. I will be facilitating audience questions at the end of the presentation to ensure our speaker addresses them. Last but not least, we will be recording this session, so if you'd like to go back and review any of the information that will be presented today, you can do so by visiting our dedicated City of San Diego employee YouTube channel. You will be sent a link to the recorded webinar once it has been uploaded. And with that, let's get started. I'm excited to introduce our esteemed speaker, Jevin Boyer, Certified Financial Coach at California Coast Credit Union. Jevin has a unique set of tools to help us understand how we think, feel, and react to money and financial circumstances. Jevin has over 20 years of experience in the financial industry and loves to empower his clients through education. Jevin is active in the communities he serves, enjoys giving workshops, and meeting one-on-one with members. Jevin has a passion for seeing his clients succeed by introducing simple, everyday habits that can change the financial story for yourself and your family. And with that, Jevin, the floor is yours.
Well, thank you, Will. And to everyone watching here today, we're so glad that you decided to take the time to invest in yourself today. We're often asked the question, how do I get better at saving? So we decided to host a class just on this topic. We call it Savvy Savings. When we think about saving money, we tend to think about saving money for practical reasons. We envision saving money to buy a house or ensure a comfortable retirement. Sometimes we think about saving for a vacation, paying for our child's education, or simply to have a cushion for emergencies. And these are all excellent reasons to save, and they highlight the importance of taking care of our finances. But do we ever stop to ask ourselves, is there more to saving money than just the financial benefits? Whenever we work with our members on setting financial goals, we create an understanding that when you save money, you're essentially buying yourself freedom. Freedom from debt, freedom to make choices, and the freedom to take risks with much less fear. Imagine wanting to start a business or switch careers or even just follow your passions. If you have an adequate savings that you've built up over time, you can more comfortably take those risks. So basically put, maintaining savings gives you the ability to live life on your own terms. And to me, that's where staying tuned in today and learning how we can make that happen. So until now, I've been using the term savings very broadly. We're going to spend the first half of today's workshop discussing 3 types of savings accounts that we believe everyone needs for financial stability. If you do not already have these 3 types of accounts at California Coast, we offer as many savings accounts as you need. And what's even better, because they're just a suffix, you don't need another account number. So I hope to convince you by the end of the presentation to have all 3 of these savings accounts set up with automatic contributions. Best of all, having all 3 of these accounts, emergency savings, periodic savings, and retirement savings, having them labeled will make you think twice before spending money. So let's get started with the first type of account that you need, emergency savings. The past few years has been a prime example of why we want to help our members prepare. You can't plan for things like a pandemic or economic shifts, but we can prepare for an emergency loss of income. How many of you know someone who's lost their job or been furloughed or had their hours reduced? Maybe you've had an injury in the last several weeks, or surgery, or even been in a car accident. We all know anything can happen at any time. And if we lose our income, and are immediately stressing out about how we're going to buy food or pay for rent. That's a really scary place to be. So again, this is why we offer that financial fitness coaching. Is a benefit of membership to our all of our members at California Coast so they can prepare for those unexpected events in their lives. One of the best ways to protect yourself is by keeping 3 to 6 times the amount of money that you spend every month in your emergency savings. And I'm sure many of us have heard this before, but where did that number come from? And the more important question, and probably on all our minds, is I'm barely able to make ends meet now. How am I supposed to save that much money? Well, first of all, let's be clear about what this money is used for. This should be primarily a loss of income emergency fund and only be used for a true emergency. This is not a savings account to transfer each month or between pay periods when we're short on funds. Maybe some of us are finding ourselves caught in that cycle. I know I sure did when I was first learning how to set the right accounts. But the reason we recommend 3 to 6 months is because that is the amount of time it usually takes to find a new job, start getting a paycheck, and getting back on our feet after losing the income we used to make. If you've ever been in this situation, you know unemployment does not kick in immediately. And even then, it only replaces a portion of what your income used to be. Most of us will need to find another job as soon as possible. Remember how we discussed at the beginning how saving money, you're essentially buying yourself freedom? In this case, if you lose your income, the more money you prioritize saving while you're working buys you more time and more choices when you have needing to look for a new career. So finally, how do we achieve that savings goal? Let's think about this like contributing to our company's retirement plan. We have that money taken out of our paychecks automatically. If we didn't, it would take a whole lot of discipline to remember to manually put that money into our savings accounts every single paycheck. And that's why so many of us have been able to build up a retirement account over the years, but have trouble keeping money in our savings accounts. Having your emergency savings automated is crucial until you can reach that goal. Now, how do I resist the temptation to use it when I'm low on funds? Well, that's where the next savings account comes in and why it's so important to have all three. So we're going to ask for a little more audience participation in this one. And I want to spend some time today mastering how to use this account, because this is the periodic expenses account is the account that's going to keep us out of debt. Periodic expenses are often the larger ticket items that only come up occasionally, but they are part of our living expenses, so we have to plan for them. So I'm going to ask a little participation. There are two types of periodic expenses. They're fixed and variable. The fixed periodic expenses means these are the ones we know are coming up. We know how much they cost. We know when they're due. They're the ones that usually come up once or twice a year. So I'm going to ask you, go ahead and you can take yourself off mute if you like. If you want to put in the chat, give me some examples of some fixed periodic expenses that you have coming up every single year you know you have to pay for. And I'll give you a minute. Just go ahead and put it in the chat or unmute yourself.
Yeah,
Someone says taxes. Yep.
Jevin, just sorry to interrupt, but everyone is on mute, so they'll have to put
okay.
it in the chat.
Well, I'm getting some great feedback in the chat. Somebody said house payment, registration, taxes. Yep. I know many of us just paid property taxes. Yep. Registration on your car is a perfect one, right? Somebody says car insurance, rental insurance, tuition. Yep. So all of these things are things that we don't typically pay every month. So we tend not to think about it when we make our financial plans. And this is what happens if we're not prepared for them, we don't have it written in our plan, they tend to go on a credit card and we get ourselves in that debt cycle. The next example is actually I think the more crucial one is those variable periodic expenses. These are the ones that don't have a due date. They're not fixed. They might be things like vacation or gifts and holidays. So go ahead and put in the chat also. Let's give some examples of some variable periodic expenses you have. Someone says car repairs. Yep. Medical surprises. Absolutely. Anyone else? House repairs is a big one. Yes, the house repairs cannot be understated. We often hear that you want to set a minimum of 2 to 3% of the value of the house just for house repairs every single year. Somebody says vet bills. Yeah, those things absolutely add up. So we're going to talk about a few of these today. We're going to go to the next slide. And here's an example. So auto repairs example. We're finding that most people are spending about $1,000 a year maintaining their cars on average. Maybe an older car you spend a little bit more, newer car you might spend a little bit less. But let's say you're even a very frugal, you're a savvy saver already, and you're already finding coupons for the oil change, and you found yourself a $40 oil change, but you still might need to do that 2 or 3 times a year. We know tires don't last forever, right? That might be $600 to $800 every couple of years, depending on how much you drive. We know we have regular maintenance. I think somebody already mentioned DMV renewal, and we could see how we can easily spend, $100 a month or $1,200 a year maintaining our cars. So the idea would be, let's take that $1,200 or the $100 a month. Maybe every paycheck we put $50 into an auto expenses account, and that way it's there for us, and we don't need to worry about when those expenses come. In the same way, maybe we have our home expenses account. I mean, we all have things like computers, TVs, mattresses, tools, kitchen supplies, all these things, they don't last forever and they have to be replaced. So in the same way, let's add up how much we expect to have to pay to replace those household items that break down and make sure we're putting that money into the savings account. Another example I want to show you is these gifts and holidays. So gifts and holidays is one area that we find we spend much more than we realize. Because when we plan for gifts and holidays, we tend to think about birthdays and Christmas. We think, okay, let's get the kids Christmas gifts, get the birthday gifts. But every holiday, let's say, for example, Halloween, there's costumes and candy and decorations. Christmas, we got the Christmas tree and all the events we do and the gift wrap, the kids' parties, we got the cake and the decorations. We have a lot more than just the gifts. So I'm going to show you something kind of fun. And that's a little story. So every year, my wife and I would always get an argument over how much we spend on gifts and holidays, right? She's more generous and likes to spend more money and she wants to give everybody a nice gift. And, I say, stop spending money. If you're ever in a relationship and you find that, and you're having the same conversations, here's something we did. You put together a gift grid. You say, okay, this is the event, this is the holiday or the birthday, what we're doing. This is who we're going to buy for and how much we're going to spend. And by having that all written down in advance, it gives you so much more financial peace. So a little pop quiz time. What is an example of an unexpected expense? Go ahead and put it in the chat if you think you know the answer. An example of unexpected expense: A, new tires; B, new shoes; C, cell phone; D, all of the above; or E, none of the above. Getting a lot of different answers, a lot of D's, a lot of E's. Somebody asked if the slides will be available afterwards. Yes, somebody, in case they have to jump off the call, yes, the slides will be available. You can reach out to Will and he can send you the presentation afterwards if you have to go early. But the answer to this one is E, none of the above. So let's talk about why. So again, we've talked about how tires, they're an unknown expense. We know these things aren't going to last forever. We're going to have to replace them. New shoes, again, everything's wear out. A new cell phone, how many of you have bought a new cell phone in the last 2 or 3 years? Well, that's not going to last forever. We're eventually going to have to replace all these things. So none of these things should actually be an unexpected expense. So how do we save for these unexpected expenses, or how do we save for these known expenses? Well, one way you can do is we talked about setting up different types of savings accounts. And I'll tell you, I have the first 4. I have an auto repair savings, vacation savings, a gift and holiday savings, and a home repair savings. So there's a few other types of savings you may want to consider. Maybe some of us have pets to save for. Maybe we have some health savings we're saving for, or specific goal savings. When we label each of these accounts, and each account has a purpose, it helps us to keep from spending more than we've planned. And it's very hard to have the discipline to move the money. So automating your contributions to these accounts is essential. So how do we set up these automatic transfers? Well, most financial institutions will allow us to set up automatic transfers from our checking accounts to our savings accounts with no fee. Unfortunately, many people don't have a written financial plan they follow each month. So too often they spend first and then save if there's anything left over. But savvy savers will spend what is left only after savings. So let's transfer automatically on the day after you get paid so that you're saving before you start spending your paycheck. So one effective method I've seen recently is people are setting up their savings accounts and they're automating into their periodic and their emergency savings or retirement savings on the first of the month. And then they'll put up all their line up all their bills, their monthly bills on the third of the month. So they're literally paying themselves first. Okay, the last step to being a savvy saver is understanding your long-term financial health. The sooner we get started, the better off your future self will be. So let's break this down. Let's break down the power of compound interest with using this example of Carrie's and Chris's investments. The average yearly return of the S&P 500 over the last 50 years has been right around 12%. Adjusted for inflation, the average stock market return over the last 50 years has been right around 8%. So let's be conservative and use that 8% number to illustrate this concept. Carrie invested for only 10 years, from the age of 25 to 35. Her annual contribution was $5,000 a year, so her total contribution over the 10 years was $50,000. Now, Chris invested for 30 years. He waited until he was 35 to start investing and invested from age 35 to 65. His annual contribution was also $5,000, but his total contributions was $150,000 because he invested his own money for a much longer time. So despite Carrie investing for a shorter period of time and contributing less overall, her investments grew significantly more due to the power of compound interest. So here's why. Carrie started investing earlier, giving her investments more time to grow. The longer the money is invested, the more it benefits from compound interest. Chris started investing later, which means his contributions had less time to compound. Even though he contributed more overall, the shorter growth period resulted in less accumulated wealth. So starting early and allowing investments to compound over a longer period of time can lead to significantly higher returns. So if we're asking ourselves now, how can I save $5,000 a year and contribute to my retirement like Carrie or Chris, no matter what age I'm starting? So remember how we talked about setting up the periodic expenses account? That's what's going to help you pay for those occasional expenses that typically would have gone on credit cards and keep you out of debt. So let's explore what happens if I don't keep money in a periodic savings to pay off my credit cards in full. So here's a typical example of maybe a member will come up to me and they say, okay, I've got car loans, I've got 3 credit cards, I'm barely making ends meet. How do I pay this off? Maybe they have a car loan at 7.5%. They have 3 credit cards, also the standard interest rates, as you can see in this example. But if you total up all the interest charges for the month, this person's paying about $527 in interest each month. That's over $6,000 a year. So chances are, it's likely that many of us are carrying the balance on their credit cards, but let's look at this another way. Another way to look at this is if you knew that credit card number 1, if you were told that there'd be $127 monthly fee to have that card, would we have signed up for it? Probably not. So if this is looking like your finances right now and you're having trouble paying off credit cards in full, please, let's contact the financial fitness department at California Coast Credit Union. Set up a meeting with the coaches. It's a free benefit of membership with us. Another savings recommendation we have is called the thirds method. So maybe you're going to get money for your birthday, you get a bonus, you sell something, or get an unexpected inflow of cash. We recommend using what's called the thirds method, where you put a third of the money into your emergency savings, you put a third towards your debt, and then you take that last third and do some guilt-free spending, something you've always wanted to buy. This method helps satisfy many areas and helps you build financial stability more quickly while still celebrating that extra income. You can go a step further if you want. You can do what's called the fourths method, and you can actually put some extra money towards your most important financial goal, because it's an amazing feeling to finally check that accomplishment off your list. So how do we determine what our most important financial goal is? If you meet with us one-on-one, we're going to help you develop that. using the SMART method. And many of you have seen this before. It stands for specific, measurable, attainable, relative, and time-based. So specific, we got to get specific about what our savings goals are going to be. Specific, what do I mean exactly? Maybe you'll say, I need a vacation, or I want to go to Spain in September of 2026 for 1 week. Very specific. We'll know exactly how much we need. Maybe some people will say, oh, I just want to be debt free, or I want to have all my credit card debt paid off in 2 years. So again, we're getting very specific. Measurable. How do we know when we've achieved it? How do we know how much we want to save and by what time? And it's got to be attainable. It's got to be a goal we can achieve. A lot of people, they sign up for meetings with us and they're very excited. They say, I want to pay off $10,000 in debt in 1 year. And that's a fantastic goal. But we have to realize that's $833 extra every month that we'd have to be able to save and pay down that debt. And that may be a little bit out of reach. But what about 3 years? 3 years will be $277 a month. Now, maybe I can do that. That might be a little more realistic. Now, we could make that $833 a month happen if that was truly our goal. We're willing to get a second job or rent a room or sell things or not eat or go out to eat or have any fun for a year. We could make that happen, but we have to be totally concentrated and determined to make that happen. It's got to be relevant. It's got to be something that you want, not something that other people want for you. If you are not committed to the goal for yourself, the motivation is very hard to have motivation, to keep the motivation to be willing to work for it. And lastly, timely. How long do we need to achieve this? Let's have that date set in mind so you can measure your progress. So I'm going to again open it up. What do you guys have? What's on your mind? What are some of the goals that you guys have? Go ahead and put it in the chat if you guys have a very specific goal that you're working on. Somebody says a new car, saving for kids' college, small wedding. Fantastic. A trip to Europe. You guys have great ideas. So like I said, if you don't have a written plan in place and you're already making automatic contributions to that, please give us a call. Let's set up an appointment. Somebody says home ownership. Yeah, we teach a class just on how to prepare to buy a home. Absolutely.
Jevin, I unmuted everybody. If they want to unmute themselves, they can go ahead and ask a question out loud. Something came in the Q&A. Someone mentioned college is their goal.
Fantastic. Yep. So we teach a whole class just on paying for college. And here's kind of a little tangent, but if what you're going to learn in our college prepare class is a lot of parents and students tend to think they have to borrow money to go to school. But there's so many other ways. There's so many scholarships and grants and work study programs out there that if we're exploring those in the years before we go, we can have so much of our tuition paid for. So if we cannot underestimate the resources that are out there and do a little research, we'll save ourselves years of hardship of trying to pay back those student loans. Was that helpful? A trip down under 2 years. I like that. That's fantastic. Okay, let's keep moving. So here are a few other ideas. Once you are automatically contributing to your emergency, your periodic, and your retirement savings and are ready to take it to the next level, here's a few other options. Here's a few other savings ideas we have. One is boost your savings when your salary increases. By automatically increasing your savings whenever you get a raise, you can ensure that your savings grows alongside your income, helping you build wealth without feeling the pinch. Using the 24-hour rule. This rule helps you curb impulse buying by giving yourself time to consider whether you truly need that item. And oftentimes you'll find that the urge to buy something fades after about a day or so. Number 3, cancel streaming subscriptions. Many people subscribe to multiple streaming services, but only keep a few regularly. So canceling unused subscriptions can help free up money without sacrificing entertainment. Number 4, look for other bills that you can lower. By reviewing and reducing the recurring bills, such as utilities or phone plans, can lead to significant savings over time. Small adjustments can add up to big savings. Number 5 is remove your stored payment methods from online retailers. And this one's probably my favorite. By deleting saved card information, you can make it far less convenient to make impulse purchases, encourage more thoughtful spending. And lastly, if you want to explore more savings, you can go to www.americasaves.org. This is another website that offers just a wealth of resources and strategies to help you save more effectively to reach your financial goals. So with that, does anyone want to unmute themselves, put in the chat, kind of share with the group other things that they have done that's really helped them?
Yeah, Javon, just curious if you all have, is there a finite number of accounts that we can use if we did have, a whole bunch of different ones we wanted to allocate money to?
Nope. You usually have as many as you need. And that's the nice thing about the credit union is you're going to have one checking account number. That's, account number 1, 2, 3, 4, 5. But then you have maybe your auto repairs is suffix number 2, and your home repairs suffix number 3, and your pet savings for pets suffix number 4, something like that. So you can have as many accounts as you need and without worrying about having a different account number. Is that helpful?
Yeah, and I heard it's just as many as 10 or so account savings shares that you can open with that checking account at no additional charge, and
Okay,
label them accordingly to whatever that purpose is.
Somebody asked a question about a money market savings and it's worth having one. Yeah, so the money market savings is simply going to give you a higher return on the money that's in your savings account. So absolutely, it's worth having one. Yes. Somebody mentioned having a direct deposit at an institution that's far away from you lessens the ease. Yeah, so Glenda, I'm actually glad you shared this because when I was first starting to do this and learning how to do this, I had the same thing. I was getting this cycle where every paycheck, when I was low on funds, I'd pull from that savings and I could never get caught up and build that 3 to 6 months. So actually, that's exactly what I did. I set up a savings account at another institution. I didn't set up, bill pay or online banking, and so I never wanted to see it. And a year later, I checked in. I was like, oh wow, I saved a lot more than I realized I would just by detaching it. Yeah, and that's kind of the idea of the separate savings accounts with them being labeled. So we're far more less likely to use that money. Thanks for sharing. Okay, well, with that, we now have some tools to help you become a savvy saver. If you wanted more information, not just about savings, but maybe you wanted to learn how to increase your credit. Maybe you want to learn investing or retirement or learn how to start a business. You can go to www.calcosu.org/enrich. There's all kinds of tools, videos, courses, articles. You can also check out our YouTube channel where this video will be on and other videos as well. If you want to schedule an appointment with one of the coaches, it's a free appointment. There's a QR code to scan it. I'll leave that open for just a minute. And then lastly, also, if you want more information on the financial fitness program, how to contact us, you go to financialfitness@calcosu.org. There's our phone number. Myself, Jevin Boyer, there's my phone number and email address. Yeli Fernandez is our Spanish speaker, if you prefer to work with a Spanish speaker, and Carolyn Rose is the manager of our program. And with that, I will turn it back to Will and open it up for questions about anything we talked about today.
Jevin, thank you very much. That was a lot of great information and actually some small steps that we can actually start implementing now. So that's a great way to start our savings journey. I just want to remind everybody, if you have a question, feel free to either put it in the Q&A or you can put it in the chat and we'll be happy to answer those actually. And you can unmute yourself as well. If you want to unmute yourself and ask a question, feel free to do that. And so we had a question about I'm living paycheck to paycheck. How do I start with a emergency savings when I have only enough to cover my basic needs?
Yep, absolutely. That's a great question. So that's what we specialize in. And what an appointment would look like is we'd go through your credit report line by line, teach you how to read it, find some tips and tricks to help you improve your score, reduce debt. We're also going to go through a month's worth of tracking, spending. How much am I spending on SDG&E? How much am I spending on utilities? How much am I spending on groceries and meals out? And we open up that cash flow. We find everywhere we can. Now, yes, it might be a little bit of a pinch, but almost anybody can open up cash flow, at least a little bit, to start saving, for a month. We got to get that habit. Maybe it's $25, maybe it's $50. And it might not seem like a lot at the beginning, but we can find ways again to reduce the cash flow, give you some tips and tricks to help reduce the debt and expenses, and start building that savings. And we build that into the plan. So before the month begins, you already know where every dollar is going. Is that helpful?
No, that's great, Jevin. Thank you for that. Another question came in. I currently have credit card debt. Should I prioritize paying down the debt, or should I set money aside for my emergency savings, which I have none?
That is a great question. And I'm so glad you asked that, because so many of us are finding ourselves in that boat. And I get the question a lot. And I'm going to give you a not so helpful answer. But the answer is yes, both. And how do I save both? How do I pay off the debt? And how do I put money in savings? So the reason I say this is we're in that cycle, right? If we don't have money in savings, things are always going to come up, right? Things are going to come up with the kids and come up with car repairs. And you're not going to be able to get ahead. And we're just going to put more things on the credit card and then pay interest on that. So my recommendation is, if we have absolutely nothing in savings, we have to prioritize that even above paying off debt. If we don't have at least say $1,000 to start with in the savings account, the next emergency that comes up, we have no other choice but to put it on a credit card, right? So even if it costs us a little bit more of interest long term, it's so imperative that we have that savings account foundation set up, so we have that money to pay for an emergency, rather than, again, a credit card with even more interest. Was that
Right.
helpful?
Yeah, that's the age-old question, that when people have debt, but emergency savings is crucial to not getting further into debt. So that's a great strategy for tackling both. Question came in about, how do you recommend using the small savings accounts, for trips, for gifts? Do you transfer the savings to a debit card, or how does that work when you've saved the money, but now you got to make the purchase?
Yeah, that's a great question. So I'll tell you exactly what I do. I told you I had 4 savings accounts, 4 suffixes. I have one for auto repairs, one for gifts and holidays, one for vacation travel, and one for house maintenance. Now, each paycheck, I have $50 put aside into each one of those accounts. Again, it doesn't seem like much, but it adds up, and I was sure glad I had it there. But what we do with that is, if we need to buy something like a oil change or new brakes, it only comes from the savings account. So yeah, I transfer it. Let's say I go to the mechanic and I need to get it's $250 for new brakes. Then I transfer that $250 into the checking account and pay for it. Same way with gifts and holidays. If we're going to go out and do Christmas shopping, and I decided, okay, $200 is our number, that's what we can spend, $200 gets transferred before I go do the Christmas shopping. Did I answer that question
Yeah.
for you? Was that
Yeah,
helpful?
absolutely. Absolutely. And what about if you want to be able to take advantage of rewards programs using credit cards? You've saved the money,
Mhm.
but now how are we able to take advantage of the, rewards?
Yep. So a lot of people do like to use credit cards for the rewards programs. The only cautionary thing I would say is, make sure you have the money in your savings to be able to pay that off in full. Basically, it's kind of funny, pay it off in the full in the parking lot before you drive home. And that sounds kind of funny, but if we don't have the money to pay it off in full, then we probably should not be utilizing the rewards, right? Because then anything could happen. We talked about, we could lose our jobs, we can get hurt, we can get injured. And I would hate to be in that position where we are trying to go chasing after the points and the rewards. We lost our income, and now we can't use that money that we had saved to pay off the credit card debt in full. So as long as you have the money to pay off the credit card in full, go ahead and use those points, enjoy them. But I would shy away from it until we have the money set up in the periodic savings.
Awesome. Thank you.
Yeah.
Someone asked about, will there be a seminar diving more into investments? And I can answer that question. Is later on this year, we are going to have another webinar on retirement strategies. And at that point, we're also going to cover other types of investments that are outside of retirement. So that should be coming before the end of the year. So just keep an eye out on your communications that are sent through, and we should have a webinar on investments and retirement strategies before the end of the year. So hopefully that answered your question. So stay tuned. Another question asked, can anyone join CalCoast, and even children, can they join CalCoast as well? You want me to answer that?
Yeah, go ahead. Go ahead. Will.
Okay, I can answer that. Absolutely. Anyone who lives, works, or worships in San Diego, Riverside, and then let's add the 5 other counties that we're in: Orange County, Los Angeles, Imperial, and San Bernardino, I believe. If you live, work, or worship in any one of those, you can open an account at CalCoast. Now, with the partnership with the City of San Diego, there is normally a $5 membership fee, but that is waived. So you can join absolutely free as being an employee of the City of San Diego, and your children can open an account. So the $5 would be waived for them as well.
Will, can you clarify that $5 that's waived? That's not a monthly fee. That's just a one-time.
Oh, yeah. Yes, I'm sorry. The $5 is it's a one-time membership fee to join the credit union. It's part of the bylaws of joining a credit union, but being a partner with the City of San Diego and California Coast Credit Union, we have a special partnership where that $5 is waived for employees of the city. Another question about online banks that are offering either high yield CDs or high yield savings accounts. Are those worth it?
Yeah, they absolutely can be. This is kind of funny. I learned that Credit Karma is actually a bank. So they offer great interest rates. For example, so there's all kinds of online offers. If this is money that you don't plan to use, or you need it, and it's pretty easy to move around, but go ahead and take advantage of those CDs and rates. Absolutely. Don't have nothing wrong with them. And to someone's point earlier, sometimes hiding that money away in a place where you don't see as often or access as often might help you build that savings if you set up that automatic contributions every month.
Excellent. I might want to point out too is just make sure that they're insured either through the FDIC. There's a lot of fintech companies out there that are offering high interest rate accounts, so you just want to make sure that they're insured through the FDIC.
Yeah, great point, Will. Thank you.
Okay. Any other last questions before we sign off? Jevin, I just want to thank you for all that great information. That was great practical tips for saving and addressing debt that we might have, and just preparing for any emergency or future needs. I want to thank each and every one of you for spending this afternoon with us. We sincerely hope that you've gained some new and valuable insights that you can apply to your financial journey. Your presence has truly made a difference, and we appreciate you taking the time out of your busy day to join us this session. Until we meet again next month, wishing you continued success on your path to financial well-being. See y'all next month.